Bismillahirrahmanirrahim. Assalamu alaikum everyone. My name is yasiryamin and I welcome you all in this session. Now, like always, in this particular session, we are also going to discuss one very important accounting standard and we are going to do some questions on it. The sole idea of having such type of a session is that we make sure that we make sure that we strengthen our concepts regarding a particular accounting standard, and this practice will help us in really looking after the more tougher questions that we might see in an exam. But the concepts, they always help you along the course. All right, so let us begin. Guys, in today's session we'll be discussing about IFRS 15. IFRS 15 is one IFRS 15 is about revenue from contract with customers. Now, before even beginning to do some practice questions, let us just have a recap of what we discussed in IFRS 15. Let us have a very brief recap. So IFRS 15 was all about revenue from contract with customers, and it provides guidance on how to recognize revenue. I mean, what should be the process that should be followed in order to recognize revenue? The fundamental principle that has been defined under IFRS 15 for revenue recognition is that an entity shall only recognize revenue when a particular performance obligation, which is outlined in a contract, has been fulfilled, has been satisfied. That is, when the control of the good or service has been transferred to the customer, when the entity has fulfilled all its performance obligation, then only revenue should be recognized. One of the key risks that is associated with revenue is always its overstatement. Some way or the other, if the entity is able to overstate its revenue, it would be able to overstate its profits as well, and that could be misleading for the shareholders. And in order to make sure that correct revenue, whatever has been earned by the company, the correct revenue is being recognized, IFRS 15 has provided a 5-step approach towards revenue recognition. It starts with, identifying a contract with customer. There are certain conditions which, if met, you will say that conditions, justify that there is a contract with customer. And even after you have identified a contract with customer, you cannot proceed further. First of all, you identify how many performance obligations are there in the contract and how will they be satisfied. Now remember, a performance obligation is tend to be separate when it can be provided on its own and the customer can enjoy the economic benefits of that good or service on its own. The satisfaction of performance obligation is always is always categorized in any of the two headings. Either a performance obligation could be satisfied point in time, that is, for example, you transfer a good to your customer and that is when you fulfill your promise, you recognize revenue at that time. Or there could be a scenario where there is a long-term contract and you tend to satisfy your performance obligation not at a point in time, but actually point over time. Like my services, when I teach you guys, when I made a contract with you, when you guys made a contract with me that I'll be teaching you this particular course, are my satisfaction of the obligation that I have taken upon myself will not be satisfied in just one day, but it will be satisfied over the period of time that I teach you. That is satisfaction of performance obligation over time. And logically speaking, the revenue should also represent the pattern in which performance obligation is being satisfied. If the performance obligation is satisfied at a particular point in time, then revenue is also recognized at a particular point in time. If the performance obligation is satisfied over a period of time, then the revenue should also be recognized over a period of time. That is what happens in step number 2. In step number 3, we determine transaction price. Now, transaction price is technically the price at which the transaction is happening. But IFRS 15 provides, more guidance on it. IFRS 15 says that, you see, whenever you see a transaction price does not only include fixed consideration element in it, but sometimes it is possible that it also has a variable consideration element in it as well. Now, variable part of consideration should also be made part of the transaction price until you feel that there are more likely chances that the entity will not be achieving this variable consideration. Make sense? Furthermore, IFRS 15 also said that whenever you are dealing with transaction price, you also make sure that the transaction price represents the fair value of the good or service that is being transferred to the customer. In this case, significant financing component topic is too much relevant. You see, for example, what happens is, let's say you made a contract with a customer with delayed terms. Or in another case, there may be a scenario where you have made a contract with customer for a delivery at a later date, let's say after 2 years, but you are receiving substantially all of the payment now. You see, I'll talk about the first case. Let's say you have provided a calculator to a customer and you have said to the customer that, okay, I'm giving you the required good or service now, but you can pay me after 2 years. Now, IFRS 15 talks common sense. IFRS 15 says, you see, there is a good possibility that when you provided a good or service to a customer right now, but you're asking for payment after 2 years or 3 years or after a delayed period of time, there is a very good possibility that you must have provided a very good transaction price to the customer. And that particular transaction price would have also included the value of time. The value of time would have also been embedded within the transaction price. So technically speaking, if I give you a calculator, Ansh, if I give you a calculator right now, if I would have taken money from you right now, I would have charged you $1,000. If I'm saying that you can pay me after 2 years, maybe I'm charging you $1,200. The extra $200 that I'm charging you does not represent the value of this calculator. It is not my ordinary activity. The extended period of credit that I have provided you and I am charging you more for that, the extra amount is only for the time that I have provided you in terms of extended credit period. So IFRS 15 wants you to make sure that the revenue represents the fair value of goods or services. The revenue should be such that it represents the ordinary business activity of an entity. And therefore, sometimes whenever there is a significant financing component involved, you need to segregate the time value impact from the transaction price and make sure you only recognize revenue as the fair value of goods or services, or as the present value of cash flows, which is the real value of the goods or services if they were paid now. All right. So these kind of things happen in determining transaction price as well. Moreover, the step number 4 was about allocation of transaction prices. That the allocation of transaction price upon separate performance obligation should always be based on standalone prices. And finally, in step number 5, we studied that the revenue should be recognized when the performance obligation have been satisfied. We studied from different aspects. If the performance obligation was satisfied point in time, the revenue was also recognized point in time. If the performance obligation was satisfied point over time, over a period of time, then the revenue was also recognized over a period of time. And we studied in our normal sessions, in our class sessions, that whenever there is a point over time case, you just make sure that you follow a 4-step approach. You first of all assess if the total contract is a profit-making contract or a loss-making contract. You just want to make sure that the contract is not an onerous contract. Because if it is an onerous contract, you also attract the requirements of IS 37, which would require you to recognize a provision right here, right now. Make sense? Then you were used to determine stage of completions that could have been calculated according to input method or output method. And then you would be preparing a P&L extract and then in SOFP extract, and that is how IFRS 15 was articulated. Make sense? And there were certain other requirements of IFRS 15 as well. We studied about this in our normal classes, but this is a wholesome or a brief recap of what we studied under IFRS 15. Make sense? Now, I hope you have had a basic recap of IFRS 15. Now, if you have had a basic recap of IFRS 15, I want you to objectively follow me in doing these practice questions. I want your attention. And not only do I want your attention, I want your participation as well. Because if I do this on my own, I can do the whole content on my own. But in that case, only I will learn. You will not learn. So please make sure that you listen to me very carefully and also participate. Make sense? So guys, it says that LP received an order to supply 10,000 units of product A every month for 2 years. So basically what they are saying is that LP is an entity which received an order, and the order is of 2 years. By the way, it is a contract with, which will continue for 2 years. But the contract is such that you will be providing 10,000 units of a particular product, which is product A, every month. So you can call it a frame agreement. You see, practically what happens is that companies do not wish to negotiate with their suppliers, each and every time they are putting up a purchase order. So what they tend to do is they make long-term contracts. They make long-term contracts, fix their prices, and ask the supplier, entities like LP, to provide for certain amount of goods each and every month. Just imagine, you just think about it. Let's say there is a retail outlet. You can talk about Walmart, let's say. Now, Walmart has goods of Procter and Gamble's being, stored and marketed into their retail outlets. And, after every few days or after a month, Procter and Gamble were to supply repeated amounts of inventory to Walmart. But do you think Walmart will negotiate the prices every time with Procter and Gamble? Because if that is done with Procter and Gamble, the same process will be followed with thousands and thousands of, suppliers. In that case, the entity would be serving a lot of time. The entity would be spending a lot of time just to negotiate the contracts, and they won't be able to do their normal business. It won't support their cost. So what they tend to do is they make a long-term frame agreement for a consistent supply of goods and services at a particular given price. And that is what has happened with LP. LP has received a contract for 2 years, but it's not necessarily a point over time contract by now. Please try to understand what I'm trying to say. Although this is a frame agreement for 2 years. Now, any ordinary student would say, sir, it's a contract of 2 years. Technically, it's a long-term contract. It should be point over time contract. Yeah. But it's not necessarily so till the point we have read the question till now. The contract provides you to deliver 10,000 units each month at any given price, whatever has been agreed with the buyer and the seller. Since you have to provide certain amount of goods every month, each and every time you deliver 10,000 units, you are satisfying a particular performance obligation. And the revenue of that should be recognized at that particular point in time. It's not that you recognize based on percentage of completion or something like that. It's a very simple contract. Each and every time you supply goods, you recognize revenue because for that month, you have satisfied your performance obligation. Make sense? The examiner says the customer had negotiated a low price of $200 per 1,000 units and agreed to pay $12,000 in advance every 6 months. Now, there is some math involved. The prices that were agreed were such that for 100 units, the price is $200. I ask you a question. For 1,000 units, I'm sorry. For 1,000 units, the price is $200. Can everybody hear me clearly? Just confirm very quickly. Am I audible very clearly? I just need your quick feedback. Please, guys, hurry up. All right. So what it says, the contract provides for the fact that for 1,000 units, you charge to Walmart or your customer $200. Each and every month, you have to provide not 1,000 units, but you have to provide 10,000 units, which is technically 10 times 1,000 units. If $200, you were paid $200 as LP, you were paid $200 for 1,000 units, how much you would be paid for 10,000 units that you deliver each month? What should be the total transaction price? 10 times the previous price, $2,000. Makes sense? Makes sense? I mean, this is not rocket science. So in order to simplify, I can just say that we are supposed to deliver goods each month, and each month our stated revenue or our stated earnings should be $2,000. Make sense? And that is why your examiner says that the customer agreed to pay $12,000 in advance every 6 months. Make sense? So $2,000 per month for 6 months, it is 12,000. Make sense? Examiner says the customer made the first payment on 1st July X2 and LP supplied the goods each month from 1st July X2. Your accounting year end is 30th September. Your accounting year end is 30th September. Make sense, Hanan? I'll come back to you in a while. Okay. Since everybody has understood, I won't want to stop here right now. I'll come back to you. Okay. So LP's year end is 30th September. We started the contract on 1st July X2. We have to go till 30th September X2. And each month we are supposed to deliver, $2,000 worth of component. So the first delivery end would be 31st July, then it will be August, then it will be September. So we are technically talking about 3 months. We are technically talking about 3 months to go. So $2,000 being delivered here, $2,000 being delivered here, $2,000 being delivered here. Make sense? Now we have made a contract for 2 years. 2 years means 24 months. We have made a contracts for deliveries up to 24 months. Guys, I want your feedback. We have a contract which provides for the fact that we will have to deliver certain amount of goods for 24 months. But till this particular year end, we have only provided for 3 months, July, August, and September. Can we recognize revenue of 24 months? Can we recognize revenue as far as revenue is concerned? Can we recognize revenue for 24 months? Give me a yes or a no. Give me a yes or a no. I want a feedback for everyone. You say no. Okay, can I recognize revenue for 6 months? And what's the rationale behind asking this question? I have received payment of 6 months, guys. I have received payment of 6 months. So if I've received payment of 6 months, why shouldn't I recognize revenue of 6 months? Even though I'll deliver it whenever I want to, or whenever I'm obliged to, or whenever the customer requires, I have been paid for 6 months. Should I recognize revenue for 6 months? You would say no. Because you know that according to IFRS 15, revenue is not recognized when you have received the cash. Revenue is recognized when you have satisfied your performance obligation. And you only satisfy your performance obligation once you have delivered the goods. So you guys are right that, sir, we can only recognize revenue of 3 months. Although we have received some amount of money in advance, but still we can only recognize revenue for 3 months. Make sense? All right. So now here comes the question. Select from the drop-down boxes the entries to be recorded in the financial statements for the year ended 30th September X2. I mean, you need to answer me. I should include dash amount in revenue. I should include dash amount in revenue. The amount that I should recognize in revenue should be, if anybody could tell me, include dash amount in revenue. 6,000, 12,000 or 36,000? Yes, guys. Very good. It is 6,000. Very good. I include $6,000 in revenue for the year and create a contract asset or a contract liability for dash amount. Should I be creating a contract liability or a contract asset? Somebody is saying, sir, current asset or a contract asset. Why? I have received amount in advance. You see, I have received amount $12,000 for a period of 6 months, whereas I have only fulfilled obligations for up to 3 months. Don't you see that I have received some amount of money in advance for which I have not yet earned that money? I have not yet earned that money, but I have received it. Don't you think it's unearned income? It's advance income. And if it's advance income or unearned income, it should be treated as a contract liability, not a contract asset. So the answer is that you recognize a contract liability for an amount of $6,000. Do you guys agree? Make sense? All right. Make sense? Make sense? Let's move forward. The answer is A, or contract liability, and 6,000 for this. Very good. Now let's move forward. Let's talk about the second question. In the second question, your examiner says that on 31st March, DT received an order from a new customer XX for products with a sales value of 900,000. There is a contract between two parties and it's a contract for $900,000. XX enclosed a deposit with the order of $90,000. It is a 10%. It is a 10% advance. All right. And the examiner says on 31st March, by the way, please guys, listen to me. If you look at the requirement of the question, examiner says the financial statements for the year ended 31st March. And that means you have made the contract on year end. You have made a contract with your customer on last date of the accounting year. Last date of the accounting year. Make sense? You have made a contract with your customer on last date of the accounting year and you have received a 10% advance. This is a nutshell story. It says that on 31st March, DT had not obtained credit references of XX and has not determined if it will meet the order. So up till now, you are still performing credit checks and you have not fulfilled the order, by the year end. You received a contract from your customer at the last date of the year, but you have not fulfilled it yet. Now, the question says, according to IFRS 15, which two of the following would indicate that how this transaction should be recognized in the financial statements for the year ended 31st March? You have 5 options available and any 2 are correct. Let's go one by one. Can we include $900,000 as revenue for the year? I mean, we have received a contract. We might fulfill it. Can we recognize revenue? No. Sir, according to IFRS 15, revenue can only be recognized when the performance obligation has been satisfied. So this means no. Can I include $90,000 as revenue for the year? No. Revenue recognition is related not with money. Revenue recognition is related to the satisfaction of performance obligation. This is not the answer as well. Make sense? This is the advance amount. You are right. Then it says that do not include any amount of revenue for the year. Maybe because you have not satisfied any performance obligation yet. You guys are correct. Very good. Excellent. Recognize a trade receivable for $810,000. Can you recognize a right to receive cash? even though you have not provided any good or service to the customer. That does not even make sense. So this is not the answer as well. That means E is for sure the answer. You recognize a contract liability or an advance income or a prepaid income or an unearned income or a current liability. You recognize a liability of $90,000 in with respect to advance. Is that correct? The answer is yes. Make sense? Easy question. A conceptual question, but an easy question. Let's move forward. Let's see. I want your feedback. Let's see who does it, the earliest. It says that Digger commenced contract X47 on 1st July X3. By the way, your accounting year end is 30th June X4. And that means when your examiner says 1st July X3, it is the year start. It is the year start. Right? Make sense? So it says that Digger commenced contract on 1st July X3, which is start of this particular year. Performance obligations are to be satisfied over time. By the way, if performance obligations are satisfied over time, then remember revenue is recognized over time. Make sense? Revenue is recognized over time. Okay. So it says that performance obligations under the contract are to be satisfied over time, and the stage of completion is regularly assessed. So you calculate stage of completion on a regular basis. Details of the first year contract were as follows. Please note this down. This is a first year contract. This is a first year contract. So whatever calculations that you make, this is the first year of the contract. Okay. Now, examiner has provided you how much you have invoiced to the customer. Examiner has provided that cost incurred at the date of last assessment was $1,800 and cost incurred since last assessment is $200. What do you mean by cost incurred till at the date of last assessment and since last assessment? What do you mean by that? If I were you, I would have ignored it. Why? Because examiner is just trying to make a fool of you. You see, it is simply cost incurred. We called someone to perform an assessment, what should be our stage of completion at any given particular point in time, because examiner said the stage of completion is regularly assessed. It could have been regularly assessed every month or quarterly or whatever the date may be, whatever the conditions are. Whenever the last assessment was done at that date, cost incurred was 1,800. But since then, additional cost that has been incurred to date has been 200. So in simple, can I say, and I want your feedback if you understand this or not. This is fairly common sense, fairly common sense. If you cannot understand this, this is beyond common sense. Cost incurred to date or actual cost incurred to date is simply 2 million. Make sense? Whenever we performed the last assessment, whenever. It could have been on a Sunday or a Monday or a Thursday or whatever. The last time we checked, the valuer was here. The last time we checked, the cost was 1,800. Since then, till the year end, further $200 worth of cost has been incurred. And that in a nutshell means that up till the year end, actual cost incurred to date is $2,000. Do you guys understand this? Make sense? Actual cost incurred to date is $2,000. Make sense? Fine. Amount received from the customer is $2,100. Total contract price is $4,200. Estimated cost to complete is $1,200. You know why estimated cost to complete would be relevant to us? You know, na? Up till now, we have incurred cost of $2,000 and we expect that further cost to be incurred is $1,200. Can we calculate total contracts cost? Up till now, we have incurred $2,000. We will further incur $1,200. That means total cost that we have to incur is $3,200. Makes sense. Common sense, right? Then your examiner says survey of performance completed is 2520. Examiner says the company invoices the customer immediately when it receives an assessment of the amount of work done. Yeah. Examiner says what amount should digger include as cost of sales? It is relatively a straightforward question for you guys. What amount should digger include as cost of sales for the X47 contract for the year ended 30th June X4, assuming revenue is based on performance completed? Can anybody tell me what should be the revenue, sorry, what should be the cost of sales being recognized in your P&L? You remember the format of P&L, guys? You remember the format of P&L? Yeah. Revenue was supposed to be recognized based on stage of completion. Remember? And I told you for the purpose of FR exam, whatever actual cost is incurred to date is always charged into cost of sales. So you don't even need to think or work out anything. You know, these type of lengthy questions come into your exam. At a glance, you will see, oh, this is such a technical question. It has so many lines in it. It has so much length, but it is simple. We studied for the purpose of FR. It is fairly easy. The actual cost that is incurred up till now, $2,000 is simply charged as cost of sales. Your answer should be D. You do not need to perform the whole four-step approach here. It's a relatively straightforward question. Make sense? All right. Let's move forward. Question number 4. It says during the month of March, Jolly Tar sells 10 units of a product for $200 each to Sandy Beach. So there is a company whose name is Jolly Tar and they are selling to Sandy Beach. They sold 10 units of a product for $200 each. So $200 into 10 products into 10 units. That means $2,000 worth of transaction happened. Examiner says Sandy Beach can claim a 5% prompt payment discount if the invoice is paid within 30 days. What do you mean by this? Can anybody tell me? Sandy Beach, your customer can claim a 5% prompt payment discount if the invoice is paid within 30 days. What is this? Very good, guys. Very good. Excellent. This is supposed to mean an early payment discount offer. An early payment discount offer. And by the way, if you are allowing a discount to your customer based on early payment or based on bulk purchases or whatever the case may be, don't you think this is a variable consideration? Guys, we studied in our class that variable consideration could be positive or could be negative. Can I say this is a negative variable consideration for us? Because if we know that we have sold certain amount of goods for $2,000, but it is certain that a 5% discount will be applicable such that you see, $100 will not come to us. The true consideration for this transaction should be 1,900. You see, the definition of transaction price under IFRS 15 is that transaction price is the amount of consideration the entity expects to recover from the transaction. Make sense? The definition of transaction price under IFRS 15 is the expected amount of consideration that you expect to achieve from a transaction. If it is virtually certain that you will have to provide this discount because the customer will be paying in 30 days, then the true consideration, the true revenue figure should be 1,900. Does that make sense to you? Does that make sense to you? I want an answer from everyone. Does it make sense? Now, it is for us to assess. Okay, Hanan, as usual, does not understand. Let me just revise it. Hanan, we made a transaction of $2,000. Okay, first you tell me, do you understand this $2,000? Very good. Hanan, the contract that me and Sandy Beach, who is our customer, provides, that we will have to provide them a 5% discount only if they pay under 30 days. Make sense? You let me know, do you understand up till now? Very good. Hanan, if I have to, if I have to provide this discount, then can I say the true amount of consideration that I get is 1900? Do you agree with it? All right. What I was trying to mention, I have to repeat it again. What I was trying to mention is that IFRS 15 provides that transaction price is the expected amount of consideration that the entity expects to recover from a transaction. That is the definition of transaction price. Make sense? So if the entity concludes that giving this particular discount is inevitable, you will have to provide this discount. You will have to provide this discount, mandatory. Then the truth is that you haven't done this transaction for $2,000. You have done this transaction for $1,900. Does that make sense? Hanan, okay. Thank you. Now, the whole point that we need to assess in this particular context is we need to assess if the true transaction price is $2,000 or if it is $1,900. And the point of view that if the transaction price is $2,000 or $1,900, the core thing is this discount. Make sense? We need to assess if this discount is inevitable or not. Again, the point of view of IFRS 15 is we need to assess if what is the expected amount of consideration that you will receive from a particular transaction. So the whole point is we need to assess if this discount would be given to the customer, yes or no. So it says, if you read the question further, it says that Sandy Beach has also been subject to bankruptcy rumors in the national press. In the newspapers, you see that they are subject to bankruptcy. I mean, there are rumors. There is no confirmation. There is no confirmation, right? There are just rumors. You being an accountant of Jolly Tar, consider yourself as an accountant of Jolly Tar. You know that you have provided $100 5%. 5% means $100 discount to Sandy Beach. And you want to make a judgment that whether Sandy Beach would be able to pay within 30 days, yes or no. Give me your best guess. Everyone, give me your best guess. After hearing the rumors about bankruptcy, what do you expect? If you were to recover your money, I mean, if somebody says, sir, I think that I am not going to even receive my money, that's a separate story, right? But if you were to assess that if the discount would be applicable or not, what would be your best guess? They won't be able to pay us in 30 days. Just make an assessment. I'm asking you, based on this particular line, based on this particular information, do you think they will pay us early and take the discount? They are near bankruptcy. They don't have money. If they don't have money, how will they pay us on time and claim that discount? So if I were to make a judgment, don't you think that this discount is most likely not going to be applicable? And whenever I'm going to receive my money, I might receive it a bit late because of this bankruptcy news and everything. By the way, the bankruptcy is not confirmed. It's just a rumor. So most likely case, I am going to receive $2,000 because they are most likely not going to pay us within 30 days. It's just common sense, right? Yeah, it's just common sense. So, and Jolly Tar estimates that there is a 20% probability that they will not pay for goods. There is a 80% good chance that they will pay for the goods. The question is very simple. What amount of revenue? We are only talking about revenue. It's not the case of receivables. So I know that you guys will suggest, sir, that, sir, we think that 20% of the money is doubtful. So why don't we create some allowance for receivable or some provisions? I mean, don't be too quick in that regard. Don't be too quick about it. I'm just asking you about revenue. Revenue is the amount of consideration, contractual amount of consideration that you expect to recover. Do you expect to recover $2,000 or $1,900? Most likely your case would be, sir, the discount is not applicable. Most likely it won't be applicable, and therefore $2,000 is the relevant price. Make sense? I want an answer from everybody. You see, only if everybody answers, I will be more comfortable. Is that fine with everyone? Okay, so there is a comment from a student, and he says, sir, our true fair revenue price is $1,900. Do you really think that our true revenue price is $1,900? Our true revenue price is $1,900? The answer is no. We were providing them a discount against early payment. Please, please, please. We were only providing a discount against early payment. The true value of the good is $2,000. But if they pay us earlier than all the customers, then shouldn't we be providing them $100 benefit for the sake of time? That $100 discount was due to the fact that they were paying us early. If they are not paying us early, the true value of the good or service under normal circumstances is $2,000. Make sense? Make sense? The normal figure of the normal value of the good or service is $2,000. The only reason why we were giving that particular discount was due to the fact that they were paying us early. So that was early payment. Make sense? Okay. $2,000 is the answer. All right, let us move forward. Repro. A company which sells photocopying equipment has prepared its draft financial statements for the year ended 30th September X4. For the year ended 30th September X4, they have prepared draft financial statements. It has included the following transactions in revenue at the stated amounts below. The following transactions are in front of you. And the question is very clear. I want an answer from you guys fairly quickly. Which of these would be included in revenue according to IFRS 15 revenue from contract with customers? Which of the following should be included in revenue? Included in your revenue? The first question. Agency sales of $250,000. There are agency sales that we have done for $250,000, for which repro means us, are only entitled to a commission. Can we recognize $250,000 as revenue when we are only entitled to a part of this total sale? We are only entitled to a commission. Can we recognize this agency sale as a sale? Obviously, the answer is no. Remember, we studied under step number 1 of IFRS 15 that if an entity enters into a transaction in the capacity of being an agent and not a principal, in the capacity of being an agent, then you are only entitled to commission. You cannot recognize the complete amount of as revenue. So definitely this is not the answer. Then sales proceeds of $20,000 for motor vehicles. By the way, you sell photocopying equipment, okay? Keep that in mind. So sales proceeds of $20,000 for motor vehicles, which is not required, no longer required by repro. Can we recognize this sales proceeds of $20,000 as our revenue? No. Why? Not ordinary business activity. Not ordinary business activity. We sell photocopy machines. If we have sold our non-current asset, there will be a gain or loss on disposal, but not revenue. All right. Then there was sales of $150,000 at 30th September X4. The amount invoiced to and received from the customer is $180,000. Which includes 30,000 for ongoing work, servicing work, which will be done over the next 2 years. So what they are basically trying to say in part C, let me explain it to you and then maybe you can answer. The total transaction price was $180,000. $150,000 was related to some good, right? Some tangible stuff. And $30,000 was related to ongoing 2 years service for the next 2 years, the upcoming 2 years, which have not yet happened. Examiner is asking you that the transaction price is $180,000 and the option that they are asking you is, can we recognize revenue of $150,000? Can we recognize revenue of $150,000? And that means that they are saying that we are not going to recognize revenue of $30,000 that belongs to the services, which will happen over the next 2 years. Do you agree that C should be the correct answer? Yes or no? I want your opinion. Is C the correct answer? Yes or no? And I want an answer from everybody. Yes, C is the correct answer. I mean, they are correct not to recognize this $30,000 as revenue because these performance obligation will be satisfied over the next 2 years. It is not yet satisfied. And that is why it cannot be recognized in revenue. Makes sense. D, obviously D is not the answer because C is the answer, but let us just go and read it out. Sales of 200,000, which happened on 1st October X3 to a customer who has stated that they hope to be able to pay in full before the end of 20X5. Guys, why is D not the answer? In case D, there is a transaction that happened for $200,000 and the transaction happened on 1st October X3 for $200,000 worth of goods. We delivered the good to the customer. We delivered the good to the customer and made a contract for $200,000. And the customer says that I'm going to pay you before the end of X5. So let's say the customer says that I'm going to pay you on 30th September X5. That is 2 years from now. That is at least 2 years from now. Why D is not the answer? Why I say that I cannot recognize revenue of 200,000? Why D is wrong? Can anybody give me a solution? Why D is wrong? Why D is wrong? Because I have not actually received the money. That is the reason? No. IFRS 15 does not require you to recognize revenue when you have received the money. That's not the point. Nope. Nope. Can anybody tell me why D is not the answer? You know why? Can I tell you? You know why D is not the answer? Guys, the customer has agreed to pay us at least after 2 years. The customer has agreed to pay us at least after 2 years. You are selling something to a customer now, and the customer is saying, I'll pay you the money after 2 years. Don't you think this transaction includes significant financing component? Significant financing component. Please let me know. Do you guys agree or not? For sure, this $200,000 transaction price includes significant financing component because the customer is going to pay us after 2 years. Are we mad? Are we mad that we are going to allow the customer to pay us after 2 years for free? No. We must have included within the transaction price a financing element. We must have included. I mean, every sane company would do that. So if we have included within the transaction price some financing element, that financing element cannot be recognized as revenue. And that is why D is not correct. The correct treatment, although not required, please, although not required, but the correct treatment should have been that we were supposed to split some way, we were supposed to split it between the fair value of good or service, fair value of good, and the time value, the financing element included in the transaction price. Then the fair value of good or service, the true transaction price of the good or service, should be recognized as revenue, and the financing element cannot be recognized as revenue. That should have been the correct accounting treatment. And that is why full 200,000 cannot be recognized as revenue. And that is why D is not the answer. Has everybody understood about it? I want an answer from everyone, clear to everyone. Make sense? So although most of the people might have selected option number C because they understand C better, but sometimes for the purpose of our preparation, we also need to understand why something is not the answer. Make sense? Let's move forward. And I want you two guys to buck up and provide me the answers fairly quickly now. Question 6. In accordance with IFRS 15 revenue from contract with customers, when should the transaction price be adjusted for time value of money? When should it be treated for significant financing component? Let me read the options available. Where an advance payment is required, where the entity may ultimately accept an amount lower than the initially promised in the contract. For example, when you are allowing discounts, if you are allowing discounts, then you would be accepting an amount lower than what was promised in the contract because you allowed discount to the other person. When the contract includes a significant financing component, if the time between the transfer of goods and services exceed 2 years, what should be the answer? What should be the most appropriate answer? Absolutely right, everybody. The answer is C. Absolutely right. Why A is not the answer? If anybody could let me know. Why A is not the answer? If a contract requires advance, why is it not the answer? Guys, you see, not every advance will create a significant financing component. You see, there can be two possible cases. Please listen to me. I'll explain you two possible cases. There is one possible case that you have a contract with customer to deliver a constructed house and you will deliver it after 2 years. But you ask the customer to pay 100% advance now, right? Let us talk about a second case. You have a contract with customer to provide a ready-made house or a prepared constructed house after 2 years. But you ask for 5% advance from your customer. Do you think in both cases, significant financing component is involved? Do you see in both cases a significant financing component being involved? You see, taking a 5% discount is pretty normal. It does not provide anyone with a financing benefit, not the payer, not the receiver. But if it was written that there is a 100% advance, it was written that there is a 100% advance, you would have assumed that, see, if there is a 100% advance, the seller is being financed. Make sense? So why A is not the answer? Because not every advance creates a significant, the word is significant, financing component. Make sense? Does everybody understand why A is not the answer? I tried to clarify it so that you have that much concept as well. Okay. Now let's move on to question number 7 and let's see who can answer first. Which of the following is not a step in the 5-step model of IFRS 15? Which of the following is not a step? I won't even read it. Can you guys answer? Which of the following is not a step under the 5 steps that have been mentioned under IFRS 15? Allocation of transaction price, identification of the performance obligation, determination of transaction price. A, B, and D are all there under IFRS 15. A, B, and D are all there under IFRS 15. The correct point is this. Because guys, remember, under IFRS 15, recognition of revenue depends on satisfaction of performance obligation. Recognize revenue when the performance obligation has been satisfied, not when risk and rewards or ownership passes to customer. No, when performance obligation has been satisfied. So C is the answer. Correct. Good. 8th, Edifice Company. Edifice Company is a construction company that builds apartment for sale. Which of the following assets would not be recognized in the financial statements of Edifice Company in respect of contracts that has been made with customers? Which one of the following, which one of these fours will not be recognized in SOFP as far as the contract with customers is concerned to build, buildings, to build apartments for them? Which of the following cannot be related to contracts that had been made with customer? The answer is C. So you see, whenever you have made contracts with customer, contract assets will be there. Obviously, when you recognize revenue, there is always some portion of inventory. Inventory would be there. Receivable would be there. Property, plant, and equipment is not related to contract with customers. Property, plant, and equipment relates to non-current asset, which is for entities' own use. For own use. It is not for customers. Make sense? Okay. So C is the answer. Now there is one more question asked by a student. Sir, in question 6, this question, D could also have been an answer. No. You know why D could not have been an answer? If anybody could tell me why D could not have been an answer. And there is a very strong logic to it. Very good, Anand. You see, it's written in accordance with IFRS 15, when should the transaction price be adjusted for time value? It says the transaction price should be adjusted for time value when the transfer of goods and services and payments exceed 2 years. Nowhere in IFRS 15, it's written 2 years requirement. It can be 1 year. It can be 2 years. It can be 3 years. It can be 4 years. It can be 10 years. You see, under IFRS 15, a 2-year benchmark, exceeding 2-year benchmark is not provided. A significant financing component comes even after 1 year, not necessarily 2 years. So this specification that it only exceeds 2 years, then you have to adjust time value, this is incorrect. And that is why D is not the answer. Make sense? Perfect. Let's move forward, guys. Question 9. On 1st January, Ecuador enters into a contract with Terror for the sale of mining equipment for $350,000. Now, there is a company whose name is Ecuador. They have entered into a contract with Terror to sell a mining equipment for $350,000. This is the transaction price. They say under the terms of the contract, Ecuador company has an option to repurchase the equipment for $385,000 on or before 31st December. Terrier company pays Ecuador company $350,000 on 1st of January. So can anybody tell me what type of topic of IFRS 15 is being discussed here? What is this area being discussed here? This is sale and repurchase agreements. Make sense? This is sale and repurchase agreements. Now, the transaction is such that you are an entity, you have sold goods to another party for $350,000, and you, Ecuador means you, have an option to buy back these goods. You have an option to buy back these goods for 385,000. You, Ecuador, has an option to buy back these goods for 385,000. Is this a call option or a put option? Is this a call option or a put option? Remember, call options are right to purchase, put options, right to sell. What is this case? Ecuador company has the option to buy back the same amount of goods for 385,000. It's a call option. It's a call option. All right. Option, Ecuador has the option to buy back. Make sense? And when they are going to buy back, they are going to buy back at a price of 385,000, which is more. You see, the repurchase price, the repo price is higher than the original selling price. You should remember what was the outcome. If the repo price was higher than the original selling price, then this is supposed to be what? Your examiner asks you what is the correct account for credit entry in respect of the cash receipt. Should you recognize deferred income, a liability, a lease liability, a revenue? What is this? Guys, what is this? What is this? Everybody is giving, different answers. B. You have the option to buy back a certain good at a price which is higher than your original selling price. It is supposed to be a financial liability. You cannot recognize revenue. Because there is no transfer of control to the customer. Na? I mean, just imagine. Sana, just imagine. I give you this pen. You take it. And I say, you see, I have the option to take it back. Let me know. Just be fair with yourself. I give you this pen, but I tell you, I can ask for it back. Is it really a sale? Do you have ownership of this pencil if I can ask for it sometime after? If I can take it up, I have the right to take it back from you. You don't have the right, I have the right. Is it really a sale? It's not a sale. The amount that you paid to me, 350,000, and I gave you this pencil, this was just a collateralized transaction. It was just a collateralized, securitized transaction. I gave you this pencil as a security and took money from you. And when I pay you back 385,000, the extra 35,000 is for interest. It is for time value. Make sense? And that is why it's a financial liability. Okay? It's not a sale. All right, point number 10. Domgus sells new gas boilers for $1,400 each. Domgas is a company. They sell new gas boilers for $1,400. Very good. This month's special offer is a 3-year service contract with a new gas boiler installation for $1,500. The standalone price for an annual service is $100. What they are trying to say. Please listen to me. You have entered into a transaction and the transaction price was $1,500. All right. And against this $1,500, you have promised to your customer 2 things. First, you have promised gas boilers. And then you have promised 3 years maintenance. So guys, can we clearly identify two separate performance obligations within one contract? Is that so? Give me a yes or a no. We can clearly identify two performance obligations within this contract. Yes or no? Clear? If you agree with this, then you would also agree that according to step number 4 of IFRS 15, we need to allocate this transaction price to separate performance obligations. Allocation has to be done. And allocation must be done based on stand-alone prices. Do you all agree? Now, examiner is asking you what amount of the transaction price should be allocated to the service contract. What amount should be allocated to the service contract? How would you do it? You take the support of standalone prices. You see, if you were to sell a boiler on a standalone basis without any services, only the boiler would be sold for $1,400. And as far as 3 years maintenance is concerned, if you were to sell these on a standalone basis, your examiner says the standalone selling price for an annual service is $100. It's for an annual service, the selling price is $100. For 3-year maintenance, it should be $300. Make sense? Does that make sense? For 1 year, it's $100. So for 3 years, it should have been $300. So the cumulative amount of standalone price is $1,700. The transaction price that you have, is $1,500 for both, which alone would have costed $1,700. You have given it for $1,500. How do you apportion it? You apportion it within the same basis. You apportion $1,500 on the same basis as of standalone price. The calculation should be 1,500 multiplied by 300 divided by 1,700. The answer is 265. Is it clear for everyone? Is it clear for everyone, guys? The answer is 265. Make sense? Okay, very good. Question 9, explain C, the lease liability. What should I explain in this? Why this is not the answer? Because the repo price is greater than the original selling price. I mean, if you remember IFRS 15, if the repo price was less than the original selling price, then it could have been a lease liability. Otherwise, it's not a lease liability. Make sense, Ansh? It's according to the conditions of IFRS 15 only. Make sense? It is due to this fact that it is a financial liability. Okay. All right. Let us move on to question 11. A company commenced work on the construction of on a significant asset for one of its customers on 1st May X5. Guys, remember your accounting year end is 31st December and you started to work on a contract on 1st May. That is 8 months before the accounting year end. All right. 8 months before the accounting year end. It says that construction is scheduled to run for 2 years and the total contract price is $5 million. At 31st December X5, which is the first accounting year end, the following details are obtained in relation to the contract. The percentage of completion was 50%. Amount invoiced to the customer was $1.7 million. Amount received from the customer is $0.8 million. Examiner is asking you what should be the total amount that should be included in SOFP as for contract asset or contract liability. In simple, your examiner wants you to determine. In simple, your examiner wants you to make a SOFP extract and let us know if it's a contract asset or a contract liability. How do you make an SOFP, extract? You take revenue to date and you subtract any progress billings, right? You subtract any progress billings, right? And there you have either a contract asset or a liability. Make sense? Can anybody of you tell me what should be the revenue that should be recognized to date? Anybody? It's very simple. It's given in the contract. It's given in the question. What is the revenue to date? $5 million is the total contract price. Stage of completion is 50%. That means $2.5 million is the revenue to date. How much have we invoiced to the customer? Remember, the relevance is of invoice to the customer, not the amount received. Progress bill, not the amount received. So the amount that we have received from the customer is $1.7 million. And that means that the balance amount remaining to you would be a contract asset, and that should be 0.8 million. 0.8 million. So in full numbers, it should be 800,000, 0.8 million or 800,000. Does that make sense to you? Everyone, I want your feedback. Is everything fine? And if that is so, everything is done. Finito.